one of the things that we're seeing potentially cracks in the infrastructure is that, again, lenders are lending more money than maybe they should given the environment that we're in, and consumers are having a hard time paying it back. Good morning and welcome to Life in the Markets. My name's Tim Russell and today is Monday, October 20th, 2025. Last week was another interesting week in the markets, as it always is. One of the things that surprised me sitting down and writing today's episode, was that my opinion, based on looking at the various days' data last week, is that on a whole, the market seemed to be down more last week than they were up. So as I was writing my introductory paragraph, I wrote something to the tune of the markets continued to go lower this week as we digested the news from whatever. Well, it's funny when you do that, you go actually look at the data showed a rather different picture. The markets were choppy this week. We had a lot of up, a lot of down. We had some significant opening down as the market would open, maybe drop 2% on the open and then claw its way back into positive territory, only to then later sell off right towards the close. That happened at least once, if not twice last week. But on a whole, the markets were actually overall more constructive than deconstructive. So if we break it down, we're looking at the S&P 500 was up about 1.7%. The NASDAQ, tech heavy, was only up about 0.78. The Russell, the small sized companies, were up about 0.68. Gold was up about just shy of 5%. Silver was up about 3%. Oil was down over 4%. While Bitcoin was down nearly 5%, bonds were slightly positive. All right. What was driving the markets? Well, there are a lot of things right now. I think what we're seeing going on is that investors are reconsidering their upside projections based on artificial intelligence, based on what's actually happening with the economy, what's happening with the government shutdown and how that's affecting things, what's happening with the consumer, what's happening with inflation. So as all of that has been going on in the background, investors are taking a pause and reconsidering, well, where do we think markets are going to go? We don't have good government data right now because of the government shutdown. We don't have the most recent unemployment report, and there are a number of data points we would normally have to see the overall health of the economy that's just simply missing. So what fills in the gaps are earnings reports. I know, it feels like we just finished the last earnings season, and we did, but the next one is upon us. Now we're getting the first look at what happened in all of Q3 from the perspective of the banks. Many of the larger banks reported this week, and overall, the sentiment from the banks has actually been, well, financially we're good. The banks are feeling fairly comfortable. There were some credit losses. We're going to get into that a little later in the episode today, but the credit losses were fine. They weren't anything to destabilize the banks or cause any issues. They have plenty of capitalization to carry them through some bumpiness with the bankruptcies that are out there. Again, I'm going to get to that momentarily. There were some comments about consumers, and we are seeing consumers starting to slow down, kind of pull back a little bit on how much they're willing to spend. And that one data point right there, the banks are telling us, is that that's something that we need to take seriously. The impact of inflation on the habits and preferences of consumers is a real thing. And it doesn't really matter what the administration tells us. Tariffs are inflationary. They're not a good thing for the overall consumer. nor do I believe that they are going to be a good thing in the long term of our economy. I know, I get it. There are larger reasons why we may want to use tariffs as a negotiation tactic, but frankly, at some point we need to get back to business as usual. We need to be able to produce and manufacture and compete globally. And I know in some way tariffs are designed to do or accomplish some of those things, but tariffs are not a good thing. I'd rather find other ways of doing it that don't cause inflationary and business harm. Now, back to the discussion of earnings season. We also saw some interesting signs of some early cracks in the consumer lending world. So Jamie Dimon, he's the CEO of the biggest bank in the world, JP Chase, and he got on and he made a couple comments. First of all, in their earnings report, they said this: consumers and small businesses remain resilient based on our data. While we are closely watching the potential softening labor market, our credit matrix, including early stage delinquencies, remain stable and slightly better than expected. So, what is the bank saying here? We're looking at credit, we're looking at repayments, and right now, we're okay. We are seeing softening in employment, and that's concerning, but our delinquencies are lower than what we forecasted. I don't know what that means. I don't know how much they forecasted. Were they expecting this much of an increase when we had that much of an increase? Again, I don't know. Citigroup said some of the same things. One of the things that they talked about, however, was taking a step back, the macro environments, that's looking at things from the big picture, right? Looking at, maybe from a 20,000 foot level, looking down on the ground. It's a macro level. The macro environment reflects a global economy that is proving more resilient than many anticipated. The U.S. continues to be a pace setter, driven by constant consumer spending, or at least consistent consumer spending, as well as tech investments within the AI and data center world. All right, so Chase's view of the world is that everything is okay, right? The economy is more resilient than we gave it credit to. Tim, relax. All of your concerns about tariffs are maybe a little overblown, Citibank is saying. Okay, fair enough. Jamie Dimon, again, the CEO of JP Chase, in reference to some recent bankruptcy filings. There were two big ones in the last quarter, about a month and a half ago. There's a company called Tricolor. They're a used car retailer in the southwestern part of America. They serve generally the more Hispanic. Frankly, it seems like they serve a lot of illegal immigrants is what it seems like may be going on. They filed for bankruptcy, as well as another company that manufactures and produces auto parts for lots of different places. These two companies filed for bankruptcy. They're looking like the Tricolor could be about $1 billion, and the other one, I think, could be up to $10 billion in losses due to the bankruptcy. One of the things that we're seeing potentially cracks in the infrastructure is that, again, lenders are lending more money than maybe they should given the environment that we're in, and consumers are having a hard time paying it back. It sounds like, and this is not something I know for certain, but it sounds like one of the things that's causing Tricolor problems is because part of its business model was to lend money at very high interest rates, 20+%, to subprime borrowers. Guys, by the way, those subprime borrowers were illegal immigrants. So they're lending money to them, and now that we're going through mass deportations and it's causing a lot of problems within that immigrant population, it's not a surprise that those loans are not being paid back, causing the company to go into bankruptcy. There's also some concern, maybe there's some fraud going on. there's a lot that still has to be said on that story. Bottom line, we're really watching this private credit market and seeing what's going on there and whether or not this is going to become an isolated incident or possibly the beginning of a larger thing. So I said Jamie Dimon several times in reference to this. He said, hey, my antenna goes up when things like this happen. And I probably shouldn't say this, but when you see a cockroach, there's probably more. And so everyone should just be forewarned on this one. So Jamie Dimon saying, look, when you see one cockroach in the kitchen, you know that there are more cockroaches. And when you've got an organization like Tricolor going bankrupt, it seems like that's a cockroach. And he's saying, my antenna's up. I don't have any major concerns. In fact, right now, all of our data, the bank's data says we're good. We're well collateralized. The delinquencies are perfectly in workable order and no problems. But this happened. And this causes me to say, are there other places where we could see areas and issues come out? So this is not to scare you, but this is to say, hey, we're looking at private credit. We want to make sure that the debt that we're exposed to in terms of our borrowing, specifically bonds, are higher quality. We don't want to chase low quality bonds if we can avoid it. And newsflash, we can avoid it. So that is the good news. All right. With all of that being said, I just wanted to pull back a little bit and share with you a little bit about what's going on here at the Life Group. It is a very busy October. We have a lot of seminar activity coming up over the next few weeks, as well as our annual Pastors Appreciation event this Thursday. We're going to be meeting at Shady Maple Smorgasbord, and looks like we're going to be having upwards of 100 pastors and spouses joining us for a meal and talking about the pastor as steward, helping them steward their finances, their retirement, their cash flow, their estate planning, all of those things. It's going to be a really great time. I'm really looking forward to being able to get together with these pastors and share some wisdom and bless them in that way. Keep us in prayer as we continue to guide our clients through these markets. Continue to pray for us as we try to manage the ups and downs of the economy, and wisdom just as we deal with life and decisions that come before us. The verse I'd like to close us on today comes from Proverbs 13, verse 11, and it says this: "Wealth gained hastily will dwindle, but whoever gathers little by little will increase it." My friends, this is why our heartbeat, our drumbeat for the last several decades has been slow and steady wins the race. You do not need to be a high-risk investor to get respectable and reasonable returns. In fact, our experience shows us that the investors who choose a prudent, consistent investment program or plan tend to do better than those who are simply just out chasing returns. Wealth gained hastily will dwindle, but whoever gathers little by little will increase it. Thanks so much for listening to today's episode of Life in the Markets. I hope you have a wonderful week and be safe in the markets.
The topics discussed in this podcast are for general information only and are not intended to provide specific investment advice or recommendations. Investing and investment strategies involve risk, including the potential loss of principal. Past performance is not a guarantee of future results. All information herein is from sources believed reliable, but is not guaranteed for accuracy or completeness. The team assumes no liability for any errors, omissions, or actions taken based on this material. Information is as of the date stated and subject to change without notice. Securities and advisory services offered through Genius Wealth Management. Member FINRA and SIPC.